Every month, two reports from the United States quietly do a lot of heavy lifting in Forex markets. They're called the ISM Manufacturing PMI and the ISM Services PMI. And if you've been trading for any length of time, you've probably seen these numbers move the market. But here's what I want to address right up front. Most traders either ignore these reports entirely or react to them without really understanding what they're telling you. Neither of those approaches serves a position trader well. So in this video, I'm not going to give you a trade setup, and I'm not going to tell you to buy or sell anything. What I'm going to do is walk you through what these reports actually are, why they exist, how I interpret them, and where they fit and don't fit within a long-term position trading framework. If you understand how these reports work structurally, you'll be in a much better position to factor them into your thinking. And that's the goal here. Clarity over reaction. Let's start with the basics. PMI stands for Purchasing Managers Index. It's a monthly economic survey. The Institute for Supply Management, the ISM, compiles responses from purchasing managers across major industries and turns that data into a single number. The survey asks about things like new orders, production levels, employment, supplier delivery times, and inventories. The result is a composite index, and the key threshold is 50. A reading above 50 means the sector is expanding. A reading below 50 means it's contracting. That's really the whole framework in its simplest form. Now, the ISM publishes two separate versions of this report. One covers manufacturing and the other covers services. They're released on different days and they tell you different things about the economy. What PMI is not is a direct market signal. It doesn't tell you that a currency is going up or down. It doesn't set interest rates. It doesn't determine trade policy. What it does is give you a forward-looking read on the health of two major sectors of the U.S. economy. And that's valuable, but only when you understand what to do with it, which we'll get to. It's also worth noting that PMI is a leading indicator. It tends to show shifts in economic momentum before that momentum appears in hard data like GDP or employment reports. That forward-looking quality is exactly why markets pay attention to it. So why does PMI exist as a concept? And why has it become so widely watched in Forex? The answer comes down to timing. Most major economic data, GDP, trade balances, unemployment figures, come out with a significant lag. By the time you see a quarterly GDP report, you're already looking at what happened months ago. PMI helps fill that gap. Because it's based on surveys of purchasing managers who are actively making decisions in real time, it gives you a read on where economic momentum is heading right now, not where it was. Markets don't trade the past. They trade expectations about the future. And PMI is one of the cleaner tools available for forming those expectations on a monthly basis. That's why central banks like the Federal Reserve track it closely. When the Fed is deciding whether to raise rates, hold, or cut, it looks at a wide range of data. PMI is part of that picture. Strong manufacturing data might signal inflationary pressure building. Weak services data might suggest the consumer is pulling back. These factors feed directly into monetary policy decisions, which ultimately drive the long-term direction of the currency. So PMI exists not only as a trading trigger, but as part of a broader economic narrative. It's one of the inputs that helps shape the environment in which currencies move. When I look at a PMI report, I'm not just reading the number, I'm reading it in context. The first thing I'm asking myself is, how does this compare to expectations? A reading of 52 sounds positive on its own, but if the market expected 55, that would be a disappointment. Currency markets often respond to the gap between expectations and results, not just to the result itself. The second thing I'm thinking about is the trend. A single month of data doesn't mean much, but 3 or 4 months of steadily declining readings, even if they're still above 50, can signal a turning point. I watch the trend's direction as much as the level. Third, I look at the subcomponents. The headline PMI number is useful, but inside the report you have things like new orders, which are considered the most forward-looking sub-index. If new orders are falling while the overall number is above 50, that can be an early warning of weakness ahead. And finally, I place PMI in the broader macro picture. Is this data consistent with what other indicators are saying? Is it aligned with what the central bank has been signaling? Or is it creating a divergence that needs to be resolved? That's the framework. It's about reading context, trend, and divergence, not reacting to a number in isolation. The most common mistake I see with PMI is treating it like a binary signal. Number above 50, buy the dollar. Number below 50, sell it. That's not how it works, and here's why. Markets are forward-looking, and they're always pricing in some version of the future. And by the time the PMI report is released, analysts have already published forecasts, traders have already positioned, and the expected result is largely baked into prices. What matters is whether the actual number surprises relative to those expectations. And this is where many traders get confused. They see a strong PMI report and wonder why the currency didn't rally. And the answer is usually that the market already expected strength, and the number just confirmed what was priced in. There's no surprise, so there's no sustained move. Other actual misunderstanding is around the time horizon. PMI is a monthly data point. It creates short-term volatility around the release. That volatility doesn't necessarily translate into a long-term trend. A position trader working on weekly or monthly charts isn't looking for entries based on a PMI print. They're looking at PMI as one piece of a cumulative economic picture that builds over many months. There's also a tendency to treat manufacturing PMI and services PMI as equivalent. They're not. Manufacturing accounts for a smaller share of the modern U.S. economy than it once did. Services, which include finance, healthcare, retail, and hospitality, account for a much larger share of GDP and employment. For understanding consumer-driven growth, like services PMI, often carries more weight than the manufacturing side. So where does the ISM PMI actually fit within a position trader's framework? It belongs in the fundamental context layer. When I'm building my view on a currency pair over the next several weeks or months, I'm paying attention to what the economic data is saying in terms of direction, and PMI is an important part of that. If I'm watching the US dollar and I've seen 3 consecutive months of weakening ISM data, particularly if it's showing up in both manufacturing and services, that tells me something about the underlying economic momentum. It may not be what gets me into a trade, but it sharpens my directional bias. And it helps me understand why the Fed might be signaling one thing or another. PMI is also useful for understanding divergence between economies. Forex is always relative. You're not just looking at the US economy in isolation. You're comparing it to whatever country is on the other side of the pair. If US PMI data is weakening while Eurozone PMI is strengthening, that divergence is meaningful. It affects rate expectations in both jurisdictions, and rate differentials are one of the most popular long-term drivers of currency direction. Where PMI does not fit is as a standalone entry trigger. I don't look at a PMI release and decide it's time to open a position. The data is too noisy month to month, and the short-term volatility around releases doesn't align with the kind of patient, structured approach that position trading requires. Think of PMI as part of your orientation, not your execution. It helps you understand the environment. What you do inside that environment is a separate decision. Position trading is a long game, and one of the things that separates disciplined traders from reactive ones is how they use economic data. Not as triggers, not as signals, but as context. ISM manufacturing PMI and services PMI give you a monthly pulse on 2 major sectors of the U.S. economy. And when you understand what they measure, and why they matter to the Federal Reserve, and how they fit into a broader picture of economic momentum, they become genuinely useful tools. Not for predicting the next candle, but for understanding the longer-term environment you're trading inside of. The key is learning to read them in context. Watch the trend over several months. Pay attention to the gap between expectation and result. And always ask how this data fits with what other indicators are telling you. That's the difference between informed analysis and reactive trading. The full article behind this video, ISM Manufacturing PMI and Services PMI, Trading Economics, is available on positionforex.com and linked in the description. It covers every dimension we've discussed here in writing, including the PMI framework, how each report affects Forex markets, and how to integrate this data into a structured trading approach. It's built to be a long-term reference, and I'd encourage you to read it alongside this video for a complete picture. Until next time, best to your trading.